First and straight answer is money, greed. There's absolutely billions involved.
Thousands of Irish people badly stung by bad mortgages. Is there anything that can be done to help them? Hello and welcome to Prime Time. Our programme tonight looks at the subject that could mean a lot of heartache for many homeowners. If you're one of the tens of thousands of Irish people who took out an endowment mortgage since the late 1980s, there's a fair chance that you might be in for some bad news in the next couple of years. Many of these mortgage policies are due to mature shortly, and the whole idea of endowment was that it would pay off the sum you borrowed and give you a decent surplus as well. But far from doing either of these things, it now seems likely that many people's endowment mortgages will in fact fall short by thousands of euro, leaving a large additional bill to pay. So how and why did this happen? Our economics editor George Lee has gone in search of some answers.
Tens of thousands of letters are being posted by financial institutions here. It's bad news for the 90,000 people who took out endowment mortgages since 1989. Your money, say the letters, has been gambled away, and your mortgage will not now be repaid. It was a gamble that many had no idea they were taking. And there's anger that financial institutions appear to have coined it at their customers' expense. Ordinary mortgage repayments pay both interest and principal each month to a bank. But endowment mortgage holders pay only interest to the bank while saving each month with a life assurance company. This goes on until they have a big enough lump sum to pay off the bank loan in one go at the end. John O'Mara was quoted for a £35,000 mortgage over 20 years at 11.85%. The mortgage was from First National and it was underwritten by Irish Life in 1991. The projected surplus was £12,770. In the event, he took out a £40,000 mortgage for 15 years at the same rate of interest. He has now changed to an annuity mortgage.
Well, I got the mortgage in 1991. That is, I approached First National for a mortgage in 1991. I was shown a quotation for 35,000 borrowed over 20 years at 11.85% per annum. And it showed the financial data pertaining to a repayment mortgage in a column beside that pertaining to an endowment mortgage. And on the basis of those figures, I made my decision to choose an endowment mortgage. But that decision was also based on their advisor advising me to choose an endowment mortgage as it being the best option for me. He said that I could see from the figures that the endowment mortgage also offered the prospect of a surplus after the end of the loan repayment, whereas this wasn't the case with the repayment mortgage.
At the time, John O'Mara thought he got good advice. The code of conduct for insurance intermediaries pinned to the wall of First National reassured him that the endowment policy was in his best interest and that the agent had no conflict of interest in encouraging him to sign up. But he was headed for a big shock. 2 years later, he realised that all had not been as upfront as it seemed.
Well, in the policy conditions, there was a statement to the effect that you couldn't encash the endowment policy until a period of 2 years had expired. So after about 2 years, I was busy at this time now. I was building a house, so it wasn't exactly top of my list. But after about 2 years, I rang him up and I said, what's the story with my policy? What's it worth? And it was worth practically nothing. So I was quite alarmed at this. So I said, can you please send me on details of the present position with regard to my endowment policy? So a letter was duly sent by Irish Life, and the line that really angered me was, during the first year there is no investment due to various start-up costs like stamp duty, commission and initial expenses. In subsequent years, there is 96% investment of premiums. Now that came as some shock to me. I was very angry at the time about it. I felt I'd been taken for a fool, to be honest.
This was a far cry from what Irish Life documentation might lead any investor to believe at the time. The Irish Life schedule for the Homeway Mortgage Plan, the fund into which John O'Mara's premiums were invested, promised that 100% of his premiums would go into his fund.
I took it up with him there and then. I felt that there was a potential conflict of interest. I felt that it had been misrepresented to me. But that was as far as I could go. So I was getting nowhere, basically.
People weren't being told the truth. Not just about the guarantees, George. They weren't being told the truth about how endowment, how risky they were, or how they should be outperforming the cost of borrowing, and they were unlikely to do so.
As an actuary, if I was advising clients in a situation like this, I would actually rework the figures myself and present them quite differently. And I think in a way which would highlight really the type of risk the person is taking and the potential reward or the downside involved. And it's something actually that actuaries could do and present very effectively if they wish to do so. And it must express a certain amount of disappointment personally that that this sort of effort wasn't made.
There were other hidden charges. An ongoing management fee, a policy fee and a 3 to 5% margin on the funds being managed. It meant less investment for the customer but more profit for the industry. Marybanks took out a £31,500 mortgage for 25 years from the Irish Permanent Building Society. It was underwritten by Prudential Life, now Irish Life, in 1989. She was shown a projected surplus of £14,072 when she took out the mortgage. Now she has been told to expect a shortfall of €16,209.
I was a first-time buyer and money was tight, so they set out for me a comparison, really, I suppose, between the annuity mortgage and the endowment mortgage. And in my eyes, I mean, you'd be foolish not to go for the endowment mortgage because your repayments per month were less, and at the end of it, it was like a savings policy as well. Not only would it pay your mortgage, but you'd have a surplus as well. So, I mean, why would you not go for it?
Did you know when you took out the mortgage that the first year's premium went entirely in brokers' fees and costs and commissions?
Not at all. Not at all.
And I presume, would you consider that to be expensive?
Oh yeah, like your first year, your whole first year. That's mad, isn't it? I mean, that's bad that they wouldn't even tell you that. Yeah.
Mary's economy plan promised that if her investment grew by 8.75%, her mortgage would be repaid, and indicated a surplus of £14,072. 12 years later, Irish Life wrote. They said her investment had matched that growth rate, but despite this, the deal was off. Her expected £14,072 surplus had turned into a shortfall of more than £11,000. That's more than a third of what she had borrowed.
When they said the return was so poor, I assumed they know what they're talking about. I did not make a comparison with the initial one that I had been given, and I think even if I had said, well, I'll go back and check, I wouldn't have understood it. I wouldn't have understood that my policy was actually performing almost to the standard that it was projected that it should. But here in this letter, it's telling me that it's performing to the same kind of standard, but I'm going to have a shortfall. Now, I didn't notice that at all, but if I had noticed it, I would not have been able to understand it.
The latest news from Irish Life earlier this year is that her deficit has grown to €16,209, and her investment is projected to grow by only 3.75%. A far cry from the rates quoted in her original documentation.
It was made so that maybe you would get the surplus, but there was never any mention that it wouldn't cover the mortgage. You know, that was a bit of a shock.
Do you think if there was ever anywhere on that document a statement which said, by the way, this may not cover your mortgage?
I wouldn't have, no, I'm not a risk taker. I'd have gone for the other. the other mortgage. I wouldn't have taken out that mortgage.
So
no.
if any risk like that was pointed out to you, you wouldn't run a mile?
Not at all. Not at all. You know, because you can't see into the future. You don't know, well, maybe I'll lose my job. You're not going to risk your home. You've kind of saved and thought this is a wonderful thing to get your own home. You're not going to put it at risk losing it or not being able to pay the mortgage. You don't even know what your salary is going to be like. Are you then going to be able to take out another mortgage? You know, this is your big chance.
The companies hid quite a lot. By industry agreement, they set maximum investment returns for sales illustrations. It was 10.75% in the late 1980s. But these maximums were higher than what their actuaries expected to get, yet this was never revealed in the sales illustrations.
At various stages throughout the period when these products were marketed, the insurance companies agreed on maximum rates of return for illustration purposes, and these tended to be invariably used for the illustrations.
When somebody presents these kind of returns to people, the person has to understand the basis on which the actuarial calculations are carried out and what that actually means for them. And I think in many cases, no matter what return was used at that time, there was still a serious danger that the return was going to be much less than that. And I think the real issue here is the disclosure of the risk to people to say, this is not a guaranteed product, it is not guaranteed to pay off your mortgage.
The life insurance company's senior management at the time were practically all actuaries. The actuaries knew, which they had a mathematical capability of seeing through the nonsense. They were members of the Society of Actuaries. They did nothing, they sat in their hands. Even when the debate was going on, they didn't lift a finger, because they were compromised, a lot of them, by the fact that they were employed by the life companies that were engaged in making profits out of this end of the market.
Life companies say times have moved on and their practice has changed. But the policies they sold are still causing shock. Even those who got deals that looked favourable are coming up short. Reuben O'Conloon took out a £37,000 mortgage over 20 years from First National. It was underwritten by Irish Life in 1988. He's just heard his mortgage will not be covered. He's now expecting a shortfall of between €5,000 and €8,000.
The general feeling about these types of mortgages from the Building Society's point of view was that this was a very sensible thing to do, a proper investment to make.
The Irish Life brochures Reuben received pointed to all the advantages and gave a very clear demonstration of how Irish Life claimed the endowment mortgage could deliver a massive surplus over and above the traditional mortgage. It spoke of convenience and flexibility, but nowhere in the documentation does it say there is a risk that the mortgage will not be repaid.
In my mind, I can't say whether they warned me or not of a risk, but I was aware myself that there was a bit of a risk, but that was only a small risk in my mind. I felt that it was going to pay off well.